In this video, I'm going to continue on talking about distributions to shareholders. And we're going to start this video by talking about distributions through stock repurchases. And just as a little reminder, with stock repurchases, there's two ways in general that companies repurchase stock. One is through tender offer repurchases. And tender offer repurchases take place outside of the market. And so, if you own a large percentage of stock in a company and they want to get rid of you as a stockholder for some reason, maybe you're a threat to them, maybe you're looking at taking over the company and they want to get rid of you, they might go to you personally and say, we're going to offer you a premium for your shares and give you that payment so that you go away. Or in some cases, you've got large shareholders who want to sell their shares but don't want to make a problem in the marketplace by selling their shares all at once or a lot of their shares all at once. Because what would happen if they did that is that they would actually decrease the value of the shares in the market and actually lower the prices in the market if they put a bunch of shares out for sale all at once, because the supply of shares would increase relative to the demand. So those large transactions often take place outside of the regular marketplace, and those are tender offer repurchases. The other type, and the type we're going to focus on, are called open market repurchases, and those take place in the marketplace. So there are three situations that generally lead to stock repurchases by a firm. The first is recapitalizing the company. Recapitalizing the company means that they're changing the capital structure of the company. And if the company is repurchasing shares, oftentimes what it's doing is it's taken out a bunch of debt, it's issued a lot of debt, and it's using the proceeds of that debt to repurchase stock. And so what they're doing to their capital structure is they're increasing the amount of debt or the weight of debt in the capital structure and actively decreasing the weight of equity. And that can have the effect of decreasing the weighted average cost of capital. And oftentimes that's what firms are doing. And if we take a look back between approximately 2009 and 2022, when interest rates were incredibly low, many companies were doing this. They were issuing a lot of debt at really low rates and then taking the proceeds of that debt to repurchase stock. So in the end, for many firms that are doing this to recapitalize the company, it results in the firm decreasing the amount of equity on the balance sheet and increasing the amount of debt. The second reason is to have shares available for when employees exercise stock options, and this is often given as a justification for repurchasing shares. Oftentimes, though, they're repurchasing many, many more shares than they need for this purpose. The third reason why firms repurchase stock is to get rid of excess cash. And we're going to do a deep dive into this a little bit later in these notes. So the process of repurchasing stock, and I'm going to make a note here, is this is for open market stock repurchases. The first step in repurchasing stock for a firm is that the board of directors, and this is, I should mention, this is for in the United States. So the board of directors authorizes the stock repurchase. And they actually have to come out with a statement stating either a dollar amount or a number of shares that can be repurchased. The second step then is for the company to actually repurchase the shares. And what happens here is that if you go back to the last lecture, and I discussed this when I'm talking about Rule 10b-18, is that there can only be one broker per day that can trade for the company. And so the company is going to go, and the executives at the company are going to talk with the broker and discuss how many shares and what price they want to repurchase the shares. And a broker is going to then go during a day and repurchase shares. And this can actually go on for many days, different days. They can try to time the market to try to get the best prices for the stocks. But it's going to take the trades are going to take place through a broker, just like it would for you or I. Finally, the firm is going to have to record the shares and announce the shares. That's one of the requirements that the SEC has, is that in the quarter following the stock repurchase, the firm has to report the number of shares and the prices, the days at which the shares were purchased, and the prices at which the shares were purchased out to the marketplace. An important note here is that even though a board of directors authorizes share repurchases, the firm doesn't actually have to go through with the share repurchase. And actually, it's pretty common for a company not to complete a share repurchase because things might change in the marketplace. The stock price might increase, and they might, consider that it's not a good time to buy the stock. The situations with interest rates on their debt might change. So if the firm is issuing debt and taking the proceeds to repurchase the stock, and if interest rates increase, it may not be as attractive for them to do that anymore. So in many cases, a firm will not complete a share repurchase program. Either they won't start it, or let's say the board of directors authorizes $1 billion in repurchases, the firm may only do half that. So it's going to depend on the situation and changes in the market. I mentioned in the last topic area, the history of stock repurchases, starting with the changes in things in 1982. Just a brief reminder of this. So open market repurchases, again, is primarily what I'm talking about here. And this only applies to the United States. Different countries have different rules. And for many countries out there still, companies just don't repurchase stock. And they don't do it because they don't have the same rules that we do. But just a little brief history of stock repurchases. Open market repurchases really only began following the creation of Rule 10b-18 in 1982. And Rule 10b-18 created a safe harbor for firms to repurchase stock without being accused of trying to manipulate their stock prices. So that happened in 1982. Another thing that really pushed more firms to repurchase stock was a change in the tax code in 1993. I have a little article about that out here. The link is out on D2L. And it is by the Society for Human Resource Management. This is my free article, 1 of 3. Hopefully it is for you too, or maybe it's not. But it's out here. It says that on October 21st, and this was 2018, the IRS issued guidance on a change to Internal Revenue Section 162M. Okay, so 162M was enacted in 1993, and it put a limit on the amount of non-performance-based pay that a firm could pay out and deduct for tax purposes. And the amount here is $1 million. So what that meant was that in 1993, beginning in 1993, if firms paid out more than $1 million in salary, they couldn't deduct the amount that was more than $1 million. So it really pushed, and the article here talks about, a little bit what happened as a result. So what firms started doing was they started paying out $1 million in salary and then paying out millions and millions of dollars in things like stock options and restricted stock and bonuses, things that were regarded as performance-based pay, because those things were all tax deductible according to this law, this change in law. Section 162M was enacted with the goal in mind of reducing CEO and executive pay. A lot of people felt like it was getting out of hand, and so that was put in place. It didn't work. They just started paying a lot of money, and it's referenced in this article, a lot of money out using incentive-based pay. And just this paragraph here, I'll read it for you. The exemption for performance-based compensation turned out to be a far bigger loophole than had been imagined when Section 162M was enacted in 1993, explained John Lowell, a partner with October 3 Consulting in Atlanta. Many companies saw this as a license to offer base pay of $1 million to their CEO while offering incentive pay, some only very loosely incentive-based, without limits, while taking current deductions. And so it didn't have the result that was desired. The change in 2018 was that now the incentive-based pay, the stock options, things like that, are also not tax deductible. So the enactment of Section 162M provided an incentive for firms to compensate executives using stock options and restricted stock. And really, the main thing here is stock options, and that's really what we saw, was that firms started paying out a lot of stock options to executives after this. Stock repurchases have the effect of increasing the stock price, which increases the value of the stock options. So this really tied the compensation of the executive to the stock price, and by boosting the stock price, they could boost their own compensation, which is kind of a nice idea from the point of view of the stockholder, because that's really what they want. They want the stock price to go up. Critics of stock repurchases, though, would say that sometimes the short-term increases in stock prices come at the expense of creating long-term value. In other words, firms are using cash or taking out debt to increase the stock price in the short term without thinking about the long-term effects of not having that cash available for investment. We're going to dive into this a little bit more later. But this enactment of Section 162M in 1993, I'll just add that in here. And that's at that point we really saw, if you remember from last time, the graphs I showed you from Yardeni research, we really saw an increase. Well, actually, it's not in those graphs, but we really saw an increase in stock repurchases in the mid 1990s as a result of this change in the tax code. And down here below, again, I've just got Rule 10b-18. I went over this last time, but like I mentioned before, this just put rules in place so that the firm can't easily manipulate the stock price by repurchasing stock. And some of those things were a limit on the number of shares, repurchased during a single day. You can't have more than one broker. You can't use more than one broker on a single day. The firm can't can't pay a higher price than the highest independent bid. Or the last transaction price. And then finally, the fourth thing that Rule 10b-18 did was that the firm can't be the first or last trade during the day. And the rules are a little bit more specific in that, and especially that last one, depending on the size of the firm, there's a time limit. So for a small firm out in the market, they can't make a transaction within the first 30 minutes or the last 30 minutes, the idea being that they won't be the first or last trade then. And for a very large firm, think Amazon or Microsoft, they can't trade within the first or last 10 minutes of the day. And again, that is the safe harbor rule. So moving on to the effects of stock repurchases on firm value. The act of repurchasing should have no effect on the stock price. And that's really why that Rule 10b-18 is in place. The SEC doesn't want the firm being in the market and buying and selling stock to have an effect on the stock price. They don't want them to be able to manipulate the stock price. The announcement of the repurchase should increase the stock price, and I put in there usually. I'm gonna discuss that just here in a minute. And the act of repurchasing will decrease the number of shares outstanding. So, whenever a firm announces a stock repurchase, it's like, it's similar to announcing a dividend increase usually. There's a signaling effect. So the signaling effect means that whenever a firm announces a stock repurchase, it signals information to the marketplace. And there's a few things that it signals. It signals that the firm has extra cash or cash, and it signals that the firm feels confident enough to use that cash to repurchase stock. In other words, they don't need it for something coming up. There's no dark clouds on the horizon for the firm. Otherwise, the firm wouldn't be repurchasing stock. And even if the firm is taking out debt to repurchase stock, that means they feel secure enough with the future of the company that the company will be stable enough in the future to make those debt repayments. So again, they feel like things are stable. And everything's going to be okay. And the market usually responds positively to the announcement of a stock repurchase. They usually, the stock price of the firm, on average, increases by 1 or 2% with the announcement of a stock repurchase plan. And that 1 or 2% is beyond what the normal return would be for the firm that day. The reason I put usually up there is because what research also finds, though, is that companies will sometimes announce stock repurchases without the actual intention of repurchasing stock. So sometimes boards of directors and of companies will come out and say, we're going to repurchase stock, without the firm really having the means to actually repurchase stock. And sometimes they do this in an effort to increase the stock price. The market's actually pretty perceptive about this and can often tell that they're not going to complete or start with a stock repurchase plan, even though they announce one. Sorry. So that's why the announcement of repurchase should increase the stock price, and I put in there usually, is because it's sending a signal to the market that the firm is safe, that the earnings are expected to continue for the firm, and things are expected to be stable. The act of repurchasing should have no effect on the stock price. The act of repurchasing will decrease the number of shares outstanding, and we can see that when we look at the financial statements of firms. So that's what I'm going to do right now. I'm going to pull up the financial statements for a company here and show you what happens to the number of shares outstanding whenever the firm repurchases stock. So here I have the balance sheet for McDonald's, and I'm going to show you down here in the equity section. So we have the treasury stock account. The treasury stock account is how most firms account for their stock repurchases. It's a contra equity account, and it becomes more negative as the firm repurchases more stock. And the value in the treasury stock account, the negative value, is the amount they have paid in the marketplace for their shares of stock. So what we see here is that in 2018, McDonald's, at that point in its life, had repurchased $61.528 billion of its own stock in the stock market. And we see here that at that time, the firm had total shares outstanding of 765.3 million shares. And we see the next year, they increased the amount of stock repurchases by almost $4 billion, so about $3.8 billion, and their number of shares outstanding had fallen by about 20 million shares. Okay. The next year, we don't really see any decrease in shares outstanding, although they did repurchase a few shares. There's actually a slight increase in the shares outstanding on the filing date, but on the balance sheet date, they'd actually fallen a little bit here. Sometimes the firm will take some shares and reissue them for the purposes of executive compensation. We see that again the following year, not much change here. And then in 2022, they repurchased more shares, and so we see this Treasury stock account going from 67.8 billion to 71.6 billion. So an increase of 3.8 billion, or trying to do the math real quick. Yeah, 3.8 billion shares, and sorry, $3.8 billion worth of shares, and then a decrease in the number of shares outstanding again. And we see the same thing in 2023 out here. They're repurchasing more shares. That Treasury stock account gets more negative, and the number of shares outstanding decreases. So they're taking them out of the marketplace. And so the act of repurchasing will decrease the number of shares outstanding. So dividends versus stock repurchases. So if you remember, dividends are usually paid out quarterly. Companies like to keep dividends stable and increasing over time. Well, they don't really do that with repurchases. Repurchases are actually pretty volatile for firms, and that's accepted by the market because of the nature of stock repurchases. So ignoring dividends versus stock repurchases, ignoring tax effects and signals, the total market value of equity should be the same whether a firm pays dividends or repurchases stock. And again, that first thing is important, ignoring tax effects and signals, because a stock repurchase sends a different signal than a dividend increase or dividend initiation. And we're going to talk a little bit more about that later. One thing to keep in mind too is an assumption here is that, and I'm going to actually type it in up here. The assumption is that the firm is paying a fair price for the stock that it's repurchasing. So in other words, whenever a firm repurchases stock, if they take $100 of cash off their balance sheet, they're repurchasing stock that is worth $100. They're not buying stock that's overvalued or undervalued. If they're buying stock that's undervalued, that actually has an effect of creating value for the remaining shareholders. Okay. The second dividends versus stock repurchases, the repurchase does not change the stock price, although it does decrease the number of shares outstanding. And again, that's because the assumption is that the firm is paying a fair price for the stock repurchase. So they're taking value off the asset side of the balance sheet, and they're reducing the value of equity on the balance sheet by the same dollar amount. The stock price for a company that repurchases its stock will climb faster than if it pays a dividend, but the total return to the shareholders will stay the same. So what this means is that for a firm that repurchases stock, the capital gains yield, which is the percentage increase in the stock price, will be greater than the capital gains yield. There we go. For a firm that pays dividends. However, the dividend yield will be greater for a firm that pays dividends than for a firm repurchases stock. So the equation or an equation for the return on a stock or the stock return is equal to the dividend yield plus the capital gains yield. And if you think back to when we talked about the weighted average cost of capital and the discounted cash flow methods of calculating that, that's exactly what this is. There's a dividend yield. It's the expected dividend divided by the stock price plus the percentage change in the stock price. And what we used for that was the growth, different growth values for that. So the return for a stock or a stock return is equal to its dividend yield plus its capital gains yield. For firms that repurchase stock, the capital gains yield is going to be higher. And for firms that pay out through dividends, the dividend yield is going to be higher. But the idea here is that the return for a stock should be the same regardless of how they're paying out their stock and or paying out their cash and how they're giving a return to the stockholder. Okay. I mentioned an assumption here, though, that the firm is paying a fair price for the stock repurchase. Let me just make a note down here about that. If a firm is repurchasing undervalued shares, wealth is flowing from the stockholders who sell their shares back to the firm to the remaining shareholders. So, for example, if the value of my car, okay, I drive a 2016 Ford Fusion, okay. If the value of my car in the market was $20,000, let's say, it's not worth nearly that much. I wish it were worth that much. But let's say that the market value, what people are paying for it in the market, is $20,000. If I found that out, I would go sell it today for $20,000. It's not really worth $20,000 though. It's worth about $8,000 or $9,000. But if that were the case though, it would be overvalued in the market. So if I sold it to someone for $20,000, they're going to give me $20,000, I'm going to sell the car. So it's overvalued in the market. Wealth is transferring from me. However, if my car is selling for, let's say, $5,000 in the marketplace, and I sell my car, okay, it's worth more than $5,000. So wealth is actually being transferred from me because I'm only getting $5,000 for something that's worth $8,000 or $9,000. Wealth is transferring from me to the marketplace because they're getting something worth more than the $5,000 I'm receiving. So if a firm is repurchasing undervalued shares, wealth is transferred from the shareholders selling their shares to the ones that aren't selling their shares, to the company. If a firm is repurchasing overvalued shares, wealth is transferred from the firm and its remaining shareholders to the shareholders who aren't selling, who are selling their shares. If the shares are fairly priced, in other words, they're not overvalued, they're not undervalued, there's no wealth transfer. Your you're exchanging things of equal worth. What research shows us is that, at least historically, some companies that don't repurchase all the time, they kind of repurchase just a couple times a year on average, they actually do a pretty good job of finding when the share prices are overvalued or undervalued in the market. And so they go out and they buy shares that should be selling for more, and they repurchase them at a lower price, and so that's good for their remaining shareholders, not great for the people they're buying the stock from. So, comparison of dividends and repurchases. The advantages of repurchases, the main advantage is the flexibility of the repurchase. Like I said, a company can announce a repurchase and then not follow through on it. There's no liability created when a firm announces a share repurchase. When a firm announces a cash dividend, it creates an obligation on the firm to actually pay out that dividend. That's not the same for share repurchase. Additionally, when a firm announces an initiation of a dividend, a regular dividend, it creates an expectation that the firm is going to continue to pay dividends into the future. When a firm announces a stock repurchase, even if they carry out the repurchase, even if they go through and they repurchase all the stock, there's no expectation that the firm will announce future repurchases after that repurchase. The same is not true for a dividend. For dividends, an announcement creates an obligation to pay out the dividend. And a dividend initiation, and so what that means is that it is the beginning of paying a dividend, creates the expectation that the firm will continue to pay regular dividend. So an advantage is that the firm has more flexibility regarding its cash payouts if it chooses to pay out through repurchases rather than through dividends. The disadvantage of a repurchase is that it sends a weaker signal about the future of the company. And I apologize, I'm going to go back up here and create a little space here. There's one more advantage of a repurchase, and that is there's a tax advantage regarding a repurchase. So in the previous lecture, I talked about the tax differences, and right now the tax differences, if you hold onto a stock for long enough, the tax differences between a stock repurchase, the cash flow from that, and the cash flow through a dividend, they're not great. They're not big differences. However, the big advantage of a stock repurchase from the point of view of a stockholder is that the stockholder gets to determine whether or not to accept the distribution with a stock repurchase. With a dividend, that's not the case. With a dividend, if I own stock and the company pays stock, I receive the dividend. I don't get a choice in the matter. Now I can, and we're going to talk about this later, I can automatically reinvest those dividends, but I still have to pay taxes on it. So stock repurchases allow the stockholder to determine when they will accept a cash distribution. Cash dividends do not allow the stockholder to not accept the distribution. And so this creates a tax liability for the stockholder. If you receive dividends, you're going to have to pay, usually have to pay taxes on those. But if the firm chooses to repurchase stock and distribute cash in that way, if I don't choose to sell my stock, then I don't have to pay any taxes on that. So stock repurchases allow the stockholder to determine when to accept and pay taxes on distributions. So the disadvantages of repurchases, like I mentioned before, it sends a weaker signal about the future of the company than a dividend does. And so the stock price effects of the announcement of a repurchase versus the announcement of a dividend increase is usually that a dividend increase has a bigger effect on the stock price and gives investors a larger return. The way I usually explain the difference between the two is that a dividend is like getting married. Whenever a company initiates a dividend, it's like getting married. It's a long-term relationship that's created there, an expectation that it will continue on. It doesn't have to. Legally, the firm can stop paying a dividend. It can cut its dividend down, but it's usually pretty negative for the management and the board of directors should they do that. Okay, so it's like, again, a dividend's like getting married. A stock repurchase announcement's like going on a date. They might not even follow through on it. The firm doesn't make any create any expectations about the future, and so initiating a dividend usually has a greater impact on the stock price. Increasing a dividend when it is not expected usually increases the stock price by more than the announcement of a stock repurchase plan of the same size in terms of cash or in terms of amount. So the first sentence I have in there, initiating a dividend usually has a greater impact on the stock price. Initiating a dividend can actually have a negative impact on the stock price. We saw this back in 2003 with Microsoft. They announced a dividend, Microsoft did, initiation of a dividend, and the stock price fell because it sent a signal about the future of the company, that the company was not going to have really great investments anymore, or enough to use up its cash. And investors saw that as a change in the life cycle of the firm, from being a growth firm to being a mature firm. And a lot of investors didn't like that. They had bought Microsoft as a growth company. They wanted it to continue to grow. And the management and the board of directors at that time was saying, we're slowing down. We don't have all the growth opportunities we used to have. And so an initiation can have a negative effect on the stock price or a positive effect, but it usually has some effect on the stock price, one way or the other. An unexpected increase in the dividend usually increases the stock price by 3 or 4%, depending on the size of the dividend and the size of the surprise, but it sends a strong signal about the future of the company. When a company unexpectedly increases its dividend, it says the company is expected to generate more cash, and those cash flows are expected to be stable enough to support an increase in a permanent increase in the dividend. So some conclusions about dividends versus stock repurchases. Because of the deferred tax on capital gains, and that's what I was talking about with the investors choosing when to accept the distribution. It's a deferred tax. So if I don't want to pay taxes this year on cash distributions, I'm not going to sell my stock. Okay? Even if the firm is out there repurchasing stock, I don't have to sell it to them. So I can defer the tax on the capital gain. Because of this, repurchases have a tax advantage over dividends. Dividends are better suited for those investors that need a steady source of income because of transaction cost. So if I need a steady source of income, I might buy stocks that pay dividends that I can calculate. If I own 100 shares of a stock and it pays 50 cents a share, then I'm going to get a $50 check every 3 months. And so I can calculate the income that's expected to be generated from those investments. And I don't have to sell shares of stock in order and pay the transaction fees in order to get those cash flows. The third point, repurchases are useful for a firm wants to make a large shift in its capital structure, or recapitalize, wants to distribute cash for a one-time event, or wants to obtain shares for use in an employee stock option plan. So some constraints, and this is on all cash distributions. The first constraint is bond indentures. And so what bond indentures are, they're essentially agreements between the bondholders and the firm. So a restriction on dividend payments or stock repurchases can be in place in bond indentures, so the firm doesn't go out and pay all of its cash out through dividends or stock repurchases, so the firm has money or assets to liquidate in order to make payments to bondholders. Oftentimes, banks will have similar agreements in place with loans. So there can be loan agreements in place so that a company doesn't liquidate its assets and pay everything out to the stockholders and leave the bank with nothing. The same thing applies with bondholders. Preferred stock restrictions. So preferred stock generally requires that cash distributions be made to the preferred stockholders through the preferred dividends before the common stockholders get anything. So if a firm has preferred stock, the stockholders, the preferred stockholders, have to receive their dividends, and the dividends for preferred stockholders are fixed. So there shouldn't be any fluctuation in most cases on the amount that they get paid. And they do, for a firm, create a liability for the firm in many cases. The next one is something you may not have heard of before. It's the impairment of capital rule. In the United States, every state in the country has what's referred to as an impairment of capital rule. And what this means is that the firm cannot pay out so much cash to its stockholders that it impairs the capital or the ability of the firm to continue to operate. These laws vary across the different states, but the basic idea is the same. And I've seen some of them go so far as to say that the firm cannot distribute cash to the point where the book value of equity is less than the par value of the stock. So you can get kind of technical, but the general idea is that the firm cannot pay out so much cash to its investors that it stops or considerably impairs the firm from operating. The next limitation is just the availability of cash. A firm can't pay cash out if it doesn't have cash. The next one I put in here, it's not that applicable to publicly traded firms, but it can apply to a lot of privately held firms. It is a penalty tax on improperly accumulated earnings. And the idea here is that firms can withhold paying dividends or paying out cash so that its investors don't have to pay taxes on those distributions. And again, this doesn't really apply. This specific penalty doesn't apply to publicly traded firms or C corporations. It can apply to privately held firms that again are protecting its stockholders from having to pay taxes by simply not distributing cash and just accumulating a lot of cash within the firm and not paying it out. So I'm going to come back to this idea of improperly accumulated earnings after the alternative sources of capital. So the alternative sources of capital fit in with constraints because if a firm doesn't have alternative sources of capital, they will often not or they'll hold back on distributing cash because they keep cash on hand should they need it. Okay, so if a firm does not have good alternative sources of capital, they will often not pay out distributions as much as if they did. So some restrictions on getting additional capital is the cost of selling new stock. Flotation cost of new equity are high. flotation costs are the costs associated with issuing new stock and include fees to accountants, attorneys, and investment banks. I looked these up a couple of years ago and saw that for new equity issues for publicly traded firms, these flotation costs run between 5 and 10% of the proceeds they're going to receive for issuing that stock, and so they can be fairly high. The cost can be. The next is the ability to substitute debt for equity. So if a firm doesn't have the ability to issue debt, at least at a decent rate, they're going to hesitate paying out cash distributions to their shareholders because they can't make up that cash easily. And then finally, control. When a firm issues new equity to new shareholders, the existing shareholders have to give up some control over the company to the new investors. And so oftentimes firms will not want to do that, especially if the existing shareholders, you have large block holders that kind of control the firm. So I mentioned above that I was going to come back to this idea of the penalty tax on improperly accumulated earnings, because there's been some fairly big news about this over the last few years, and it has to do with the repatriation of cash. So one reason that firms repurchase stock and one reason that they pay dividends is to get rid of excess cash. So one reason why firms issue dividends and repurchase stock is to get rid of excess cash. You might think that a firm having a lot of cash on its balance sheet is a good thing. It has cash to buy things and invest in things and, for safety reasons. But from a stockholder's point of view, it's not. Cash provides very little return, if any return, for the company, and it creates what's referred to as an agency problem called the free cash flow problem. So excess cash for a firm earns little, if any, returns. And for this, think about how much you get on a savings account. So excess cash earns little, if any, return and creates agency problems for the firm. And just a little reminder, an agency problem occurs when there's a separation between ownership and control, and the owners, the stockholders, disagree with the controllers, the managers, on how things should be run. So think about if someone just handed you a big pile of cash, what you might do with that, especially if it wasn't yours, but you could spend it anyway. You might blow it on stupid things, and a lot of people do. And that is referred to as the free cash flow problem, where managers make poor investment choices because they have excess cash to play with. We have had an issue for many years with firms having an enormous amount of cash on their balance sheet, and I've got an article out on D2L that I'm going to pull up here. So out of here on D2L under distributions to shareholders, I've got S&P firms stockpile $1 trillion in cash. And then the next one I'm going to pull up to is TCJA and cash repatriation. So this article, first one comes from Investors Business Daily, a newspaper that focuses on investing. And this article was from September of 2023. It says 13 firms hoard $1 trillion in cash. We're looking at you, big tech. And so it says S&P 500 companies with most cash are squatting on $1 trillion and not rushing to give it to the rightful owners, investors. And really a focus has been Apple Computer, because Apple Computer has a ton of cash and investments. Right here it says Apple alone last quarter reported on sitting on $167 billion in cash and investments, which is actually a little bit down from previous years. At one point they had over $200 billion, and we're going to talk about in the next article why that's come down a little bit. But you've got Apple with that amount of money. It says that the massive cash pile held by 13 companies accounts for nearly 40% of the $2.6 trillion held by all of the companies in the S&P 500. And investors want to get that money back, because if I'm a stockholder and you're sitting on cash and you're not doing anything with it, I would prefer it if you gave me the cash and I could go and invest it, or I could go on a vacation, or I could buy a boat, or I could do whatever I wanted with the cash, but I want you to give it to me because it really belongs to me, the investor, and shouldn't be held up by the company. The article and the author of the article has the opinion here that companies aren't using dividends and stock buybacks or stock repurchases enough to really make a big dent in the amount of cash. And I encourage you to go through and read this article here, and it talks a little bit about the different companies and what they're doing. And I'm going to move on to the next article that explains why firms and these firms have so much cash out there. Okay. So the next article that I put out here is on in TCJA's, the Tax Cut and Jobs Act, that was passed in 2017, and cash repatriation. So what's going on? And it has to do with the fact that companies, especially these large tech companies, make a lot of their money overseas. And prior to the passage of the Tax Cut and Jobs Act in 2017, when a firm repatriated money, in other words, brought it from overseas back to the United States, they had to pay the tax differential on those dollars. So the marginal tax rate on corporate profits at the time, prior to 2017, was 39.6%. If a firm was paying corporate taxes overseas on earnings of, let's say, 15%, then when they brought the money back into the United States, they had to pay the difference between their tax rate overseas and their tax rates in the United States. And so what companies did is they just chose not to bring their earnings back to the United States. Okay. The Tax Foundation, I'm oftentimes hesitant to put articles or information out from think tanks, because oftentimes I find that they have a bias. It's not really related to knowledge about or information about the topic, but a bias related oftentimes to politics or economic theory. I generally find the Tax Foundation's pretty good about not having a lot of biases. In fact, I used to work with one of their experts. If you go to their experts page, I actually worked with one of the guys that they have as one of their experts, not on this topic, but on one of their other topics. So I kind of know the background a little bit, and they're actually pretty balanced on their reporting and their reports. So this says that in the article, it says the key findings is that the Tax Cut and Job Acts removed a barrier to repatriation for bringing money and cash back into the United States from overseas. And it kind of has a carrot and stick approach with this bringing the money back in. Firms now face a lower tax rate, bringing liquid assets back in. So it says to transition to a new system, the TCJA imposed a one-time tax of 15.5% on liquid assets. So that was going to be a lower amount than what they're going to have to pay before, but it also forces them to do it. Before they didn't have to repatriate funds. And so that's why we see, we've actually seen a decrease in the amount of cash and liquid investments that companies like Apple have, is because they're now starting to repatriate those dollars. They're bringing them back into the United States. And once they bring them back into the United States, they can then distribute those funds. But they had to repatriate the funds first before they can bring them in. I would encourage you to read through this article. It's a fairly short article, but it does talk about what's going on with repatriations of funds and how that affects the economy a little bit. And I just wanted to scroll down to the bottom here, where we can see companies are bringing more cash since the enactment of the TCJA. Mind you, this article was written in 2018, so it's a few years old, but we can see here that firms were not repatriating money really back into the United States until then. So there's a big jump in 2018, and then it fell a little bit right after that first initial jump, but it did increase for that time period right after the passage, right after the initiation of it. So that kind of finishes out the discussion of cash distributions to stockholders. Now we're going to move on to their next topic, which is stock distributions. The overview of the cash distribution policies that distribution policy is made jointly with capital structure and capital budgeting decisions. And as we finish up through the end of the course, you're going to see this. We're gonna take everything and kind of put it together in our topic on capital structure. We're going to talk more about that. Now we're going to move on to stock splits and stock distributions. So a stock split is when a firm takes its stock and it increases the number of shares and gives those shares out to the existing shareholders. So I've got an example here of a 2-for-1 split where the original price of the stock is $20. The original number of shares outstanding is 100 shares. With a 2-for-1 split, the new stock price would be $10 a share. The new number of shares outstanding would be 200 shares. So what happens here is if you own a share of stock and it splits, you get 2 shares for every share that you have. What I want you to see is that the overall value of the firm's equity does not change. Okay? The market value goes from $2,000 and stays there. So the old market value of equity is equal to $20 multiplied by 100 shares, which is equal to $2,000. The new market value of equity is equal to $10 a share multiplied by 200 shares is equal to $2,000. So no change in the market value of that stock. It's just that you have more shares at a lower price. So why do firms split their stocks? Firms split their stocks in order to keep the price of the stock liquid. What that means is that they do it to keep the stock price at a price that investors can afford. I put out an article out on D2L on the topic of stock splits, a stock split not too long ago by Walmart. Walmart used to split their stocks very regularly. In more recent years, they haven't had to because their stock price hasn't gone up that fast. But in the last few years, their stock price has actually gone up a lot. And so what I've got out here is the last article in this topic area of distributions to shareholders is Walmart's 3-for-1 stock split announcement. And this announcement comes from the company, so it's going to be very flowery and talk about what's going on. But here it says January 30th, 2024, Walmart announced that it will conduct a split of its outstanding shares of common stock at a ratio of 3-to-1. So meaning that for every share of stock you have, if you had Walmart stock on the date of the split, which was February 23rd, you're actually going to get 3 shares for every share you have. Now, again, the overall wealth effect, it shouldn't have any impact on your wealth, but we're going to talk about why it does. But it shouldn't. The goal is to get the share price down, and they explain why here. The stock split is part of Walmart's ongoing review of optimal trading and spread levels and its desire for associates to feel that purchasing shares is easily within reach. So, more than 400,000 associates participate in Walmart's Associate Stock Purchase Plan, which allows eligible associates to buy stock conveniently through payroll deductions and provides a 15% company match on the first $1,800 per year. If you're working for Walmart, this is actually a really nice thing that they have for their employees if they can afford, the cost of buying shares of stock. Walmart will match 15%, so that's an automatic 15% return on the purchase of the stock for the first $1,800 that they purchase. And they make a note down here. Sam Walton believed it was important to keep our share price in a range where purchasing whole shares, I'm going to come back to this, rather than fractions, was accessible to all of our associates, said Doug McMillon, President and CEO of Walmart. Given our growth and our plans for the future, we felt it was a good time to split the stock and encourage our associates to participate in the years to come. So, then it goes on and talks a little bit more about it, when it's going to happen, what will happen. The number of shares will change from 2.7 billion shares to 8.1 billion shares. One thing I want to talk about a little bit is the fractional shares. Purchasing fractional shares is actually not something that's been around very long. Nowadays, you can go out to a broker and you can purchase a fractional share. This has implications regarding voting. So if you purchase a fractional share, you may or may not be able to vote in a firm's stockholder meetings, and you're going to get a fraction of a dividend. You're not going to get a whole dividend whenever you do that. So oftentimes it's seen as better to at least buy whole shares. It used to be that when you purchase stock, you would need to purchase whole lots, which are 100 shares at a time. That has changed over time. It's certainly not that way anymore. At that time, back in those days, if you didn't purchase a whole lot, you paid a higher commission for purchasing shares in odd lots. Now we can buy fractional shares, and so really stock price isn't as important as the change in the stock price or the stock return. So what happened with Walmart was that on February 23rd, the stock price on February 23rd, the closing stock price So on February 23rd, the closing stock price was $175.86. And that night, if you owned shares, you would exchange that one share, or they would do it for you, for 3 shares worth $58.62 each. So there really wasn't a change in value for the stockholder, but what they had was different. So instead of having one share at 175.86, you had 3 shares of 58.62. But the goal of it was to make the price more liquid, to make it more something that people could buy easier. What happens if you don't is you end up something like with Berkshire Hathaway A. So Berkshire Hathaway A stock, Class A stock, sells for today $610,145 a share. It's a very expensive stock because Warren Buffett refuses to split the stock, refuses, we're going to talk about stock dividends, refuses to pay a stock dividend. He doesn't want to do things that decrease or make the stock more liquid. There is the B shares. The Class B shares is something that they kind of had to do. They've had a long history. At first, there were other investors that were buying Class A shares and splitting them up and selling rights to those shares, but charging a fee or a premium for those shares. And so Warren Buffett saw that and said, no, we're not going to allow someone else to make a return on my stock. So he went out and he took Class A shares and split them up to make them more affordable, and so you could buy Class B shares. They have lower voting rights and a fraction of the company doesn't pay dividends, but if they pay dividends, a fraction of the dividend, but lower voting rights. The B shares have gone through different transformations over time. The biggest one was whenever Berkshire Hathaway purchased BNSF Railroad. If you live around Topeka, you may be familiar with that. BNSF has a lot of operations here locally. And when they did that, they had to reprice these shares. They had to change the number of shares outstanding to get the price at the right level to exchange shares of Berkshire Hathaway B for shares of BNSF Railway for those stockholders when they acquired that company. But Class A shares is the price for that is what occurs when a company does not split its stock, does not pay stock dividends, and just allows the stock price to climb and climb and climb and climb. And it gets to the point where the average investor could certainly not invest at least very much in this stock without buying fractional shares. So why do firms? So firms split their stock in order to keep the stock price liquid. The reverse split is the opposite. So I've got an example here. Example is a 1-for-2 split or reverse split. The original price is $20 a share. The original number of shares outstanding is 100. The new price, if you had a 1-for-2 split, would be $40 a share. And the new number of shares outstanding would be 50. What this means is that for every 2 shares you have outstanding, you would get 1 share. They would erase a share, but the price would double. So why do firms reverse split their stocks? There's a few reasons. The first and the main reason is to increase the stock price. And this is generally pretty negative for a firm. Firms often reverse split their stocks to increase their stock prices. So you might ask, well, why would a company want to increase its stock price through a reverse split? It doesn't increase the return for the stockholders, and it would make it less liquid. Well, companies often do this when they're heading towards bankruptcy and when the firm's failing, and they don't want to be delisted from a stock exchange. So the stock exchanges, the New York Stock Exchange and the NASDAQ, have minimum price requirements. In other words, the company's stock price can't get too low or it will be delisted. It will be taken off the exchange. A reverse split is usually a very negative sign for a company, because if they're doing that to push up the value of the stock to keep it from being delisted, they're indicating that the company is in trouble. Okay. The other reason why firms reverse split their stocks is to actually reduce the number of shareholders. A famous case of this is with a company by the name of Kohler, Kohler. If you use the restroom sometimes, and I'm sure you all do, look at the toilets, look at the sinks. Sometimes they're Kohler company sinks. That's what they make. They make toilets and sinks and plumbing, things like that. They were a privately held firm, but they got too many shareholders. And this was back in the 1970s. And they didn't want to go public because whenever a company goes public, they have to start releasing a lot of information their competitors can use, information they don't want out there. And so Kohler did not want to go public. They didn't want to have an initial public offering. But the Securities and Exchange Commission requires a company to start doing the public reporting, engaging in public reporting, even if they're not traded on a stock market, after they get so many stockholders. And so what was happening with Kohler is they were exceeding the number of stockholders they could have and remain a private company. And so they started very large reverse splits to get rid of small shareholders. I don't want to go into it here, but there was a large lawsuit about this that took many years to complete. And the goal here was to keep Kohler as a privately held company, and so they were reducing shareholders through reverse splits. A stock dividend has the same purpose as a stock split, but generally on a kind of a smaller basis. Instead of having the price, or in the case of of McDonald's, getting the price down to 1/3 of its previous price, a stock split will decrease the price at a slower rate. So I give you the example here of a 10% stock dividend, where the original price is $20 a share. The original number of shares outstanding is 100 shares. With a stock dividend, I'm going to get 10% of my stock for every share outstanding. So if I own 100 shares, I'm going to end up with 110 shares. And the stock price will fall by that 10%. And so in the case of a 10% dividend, my new stock price is going to be approximately $18.18 a share. So if I multiply those two together, the $18.18 by the 110, I get $2,000 value. Before I got $2,000 value, so I'll just make a note down here. The market value of the stock before the split was $20 a share multiplied by 100 shares, or a total of $2,000. Market value after, and I apologize, not split, before the dividend, so again, the goal isn't to increase the market value of what the stockholders have. It is just to lower the price to make it more manageable. So what do studies find on the effect on stock prices? So the effects, stock splits and stock dividends tend to increase the stock price. So when they are announced, there's usually a jump in the stock price because this firm is communicating to the market that they expect the firm's stock price to continue to increase. And so they need to do this in order to keep the stock price down, okay, to keep it liquid. So it usually results in an increase in the stock price on the date of the announcement because the announcements signal company expectations for expected future increases in the stock price. Otherwise, they wouldn't do it. Otherwise, they would just not go through the expense, because there is an expense with splitting the stock or paying out or giving a stock dividend, unless they expected the stock price to continue to climb. Reverse splits usually signal something bad, like I said before. They usually result in a decrease in the stock price because they signal future difficulties for the company. Again, in this case, in the first case I give you, the first reason why firms reverse split their stocks is to keep the stock price high enough that they don't get delisted. And so there's an expectation that the firm on its own, without the reverse split, won't be able to get the stock price back up again to keep it from being delisted. Because usually companies have a certain amount of time. If the stock price, doesn't, or falls below the minimum amount for, let's say, the New York Stock Exchange, the firm has time to get the stock price back up. And what they're signaling with the reverse split is that they don't think they're going to be able to do that. So they're going to go ahead with a reverse split and push the stock price up by reducing the number of shares outstanding. The last item I have in this set of notes are dividend reinvestment plans, and I mentioned them earlier that an investor doesn't have to accept a dividend. They can have it repurchased, reinvested in the firm's stock. And I'm the faculty advisor for the student investment fund. We have a portfolio that's managed by students here at Washburn, and all of the investments we have are set up for automatic dividend reinvestment. So if a firm, or in our case an exchange traded fund, pays a dividend, we have the dividend automatically reinvested back into the fund. And something you can set up with a lot of brokerage accounts. Now, the key thing to remember, though, is that even if you have the dividends reinvested, you still have to pay taxes on those dividends. So if you can go out and set these up, but whenever a company pays a dividend, you're still liable for the taxes on the dividend, even though you're reinvesting the dividend back in the stock. So with a dividend reinvestment plan, dividends are automatically reinvested in the firm's stock. There are two general types of dividend reinvestment plans. The first type is the dividend is reinvested by the broker. And the nice thing about these is that with a dividend reinvestment plan like this is that you generally will avoid, or at least decrease, the commissions paid on those shares of stock. The other type is kind of the nice type, and that's really one, if the firm offers this and you want to reinvest the dividend, you should go with it. The dividend is reinvested by the issuing firm. There's no commission, and oftentimes the firm will offer a discount on the purchased shares. So in the second case, what happens is that the firm will actually issue shares when they pay a dividend, and the shares will be purchased automatically by the investors that have set up a dividend reinvestment plan. and they often get to purchase those shares at a small discount, maybe like a 5% discount. But what that does is it creates an automatic return for the investor that is doing enrolled in that dividend reinvestment plan. The downside, again, is that even if you're enrolled with either of these plans, you still have to pay taxes on the distribution, on the dividend. So some notes I've got down here. Another note is that a large percentage of investors choose to enroll in DRIPs, which may suggest that firms pay too many dividends, because this means that those investors don't want the dividend. They want the company to reinvest the funds that they would get through the dividend, and so they're choosing, to have those funds reinvested than to accept the dividend, meaning that the firm likely pays out. If there's a lot of these out there, the firms are paying out too many dividends. So that is it for these notes on distributions to shareholders. Please let me know if you have any questions.